Good morning, everyone, and thank you for joining us. Welcome to today's webcast, Strategic Opportunities for Competitive Carriers. And with that, I will turn it over to Chad Duval to get us started.
Thanks, Emily. Good morning, all, and welcome to what we hope will be the first in a series of Moss Adams webcasts targeted towards competitive telecommunications providers. As Emily said, my name is Chad Duval. I'm a partner at Moss Adams, and I'm the National Practice Leader of our Communications and Media practice. I'd like to start by giving you a little background on who we are, and I'll try to be quick about this. Moss Adams' Communications and Media practice works with hundreds of telecommunications providers across the country. We provide audit, tax, and regulatory compliance services to those clients. In addition, we assist our clients with a wide variety of specialty consulting services, some of which include, but not necessarily limited to, items like mergers and acquisitions, state and local taxes, wealth advisory services, IT, business continuity, and cybersecurity consulting services, as well as a host of others. Moss Adams has been serving the telecommunications industry since 1957. So there's rarely anything that we haven't seen or done. We've worked with and trained companies and regulatory agencies across the country, including the FCC, the Universal Service Administrative Company, as well as many state regulatory agencies. We've got more than 90 professionals that are dedicated to serving the telecommunications industry, and we have the depth and resources of the 12th largest accounting and consulting firm in the country. So our clients really have access to the best resources available. Okay, so I want to talk a little bit about what we're going to focus in on today. So the purpose of our webcast today is to introduce you to some strategic opportunities to help your business succeed in a competitive telecommunications marketplace. Some of these concepts are going to be new to you, and others have been around for a while, but maybe not top-of-mind items for providers that don't deal with the regulatory environment on a day-to-day basis. So maybe a bit of a refresher or learning about some things that you may well have or should have been doing for a while, but may not be doing. So wanted everyone to be aware that today's session, unfortunately, is not eligible for CPE, but future webcasts likely will be. So on that note, I'd like to introduce our speakers for today. We have three tremendous presenters today, each with a wealth of knowledge in their respective areas of practice. We're going to start with Cheri Burnham, and Cheri is a partner and leader of our Communications and Media tax practice. Cheri's been advising telecommunications providers on income tax strategies for more than 20 years and is a nationally recognized expert, and she speaks on tax issues related to telecommunications providers around the country, including Moss Adams' own tax workshops. Today, Cheri's going to be talking about some key tax mitigation strategies to consider going into 2018. Our second presenter will be Camille Christansen, and Camille is a senior manager in our Communications and Media audit practice and is the leader of our telecommunications seminar program. We present seminars across the country, a series of more than 20 different seminars multiple times across the country throughout the year. Camille has been auditing telecommunications providers for 16 years and is a renowned speaker on telecommunications accounting issues at conferences and seminars across the country. I can personally vouch for that, as I had Camille speak at a conference that I organized just last week, and she presented to rave reviews. Today, Camille will be discussing strategies for structuring leases. Our final presenter today is Tim Rutkowski, and Tim is a senior manager and leads our Communications and Media regulatory compliance practice. Tim's been in the telecommunications industry for more than 10 years and is an unparalleled resource when it comes to regulatory reporting and compliance matters. Tim's expertise spans both state and federal regulatory requirements, including regulatory taxes, fees, and surcharges. And that's really important for competitive providers who don't deal with necessarily all of the reporting requirements that other regulated or more regulated providers deal with. So understanding those taxes, fees, and surcharges is really an important aspect. Today, Tim will be discussing some of the key regulatory filings required of almost all telecommunications providers, even many that consider themselves to be non-regulated. So on that note, I'm going to turn things over to Cheri Burnham to discuss tax strategies and mitigation strategies that will have a positive impact on your business. And please remember to ask all of your questions throughout the webcast. Cheri, turn it over to you.
Thank you, Chad. So as Chad mentioned, we're going to start the discussion with tax mitigation strategies. As many of you likely know, there is much happening in Washington, D.C. in the tax landscape these days. Tax reform is working its way through Congress and is hitting the headlines quite frequently. We'll be discussing just a couple of areas to focus on in the short term as you're entering your year-end planning phase, and a lot of these concepts also will carry over to 2018. The reason that this is important is that currently companies have an opportunity to achieve potentially one-time permanent tax savings, and so there's a number of areas that we want you to at least be thinking about and focusing on. We're going to be identifying opportunities to decrease current tax obligations, but most importantly, focus on increasing your cash flow. With the tax reform that's working its way through Congress, the changes are will be happening quickly and may take effect as soon as 2018. So now is a great time to be thinking about your tax structuring and strategy. So one of the first areas that we want to touch on is entity selection. This is primarily driven by the fact that many of the congressional tax bills, we have a House bill and a Senate bill that are both, they're in the process of being merged together. And as you think about the impact for your company, one of these key areas that could have an impact on your tax obligation is how you're structured. One of the main reasons that tax structuring is becoming important is because some of the key factors in the plans that are being presented to the President really affect the way that different entities are taxed. And so C corporations will be taxed very differently than flow-through entities, which is the case today, but even more specifically, corporate tax rates are changing for both types of entities. What we're seeing in the Senate and House versions of the tax bills, both bills propose to drop the corporate income tax rate to 20%. So that's a 14% reduction from what most companies are paying today. And for large corporations, that's a 15% rate reduction. On the pass-through side, the proposals are very different. So when we think about pass-through entities, we're talking about partnerships, LLCs, S corporations. All of those types of entities are labeled as pass-through entities, which means that the income tax for the obligations of the company are not paid directly by the business, but instead those obligations flow through to the individual owners of the company. And so the tax bills, as I mentioned, if it's a C corporation, the rates are proposed to drop from 34% to 20%. But on the pass-through side, the proposals are much less clear. The House and Senate bills propose very different ways that these pass-through entities are taxed. And additionally, just the way that they're taxed, but more particularly the rates in which they will be subject to income tax. So on the pass-through side, the House version includes a 25% rate for pass-through income. However, it's very limited in its application, which means that a certain portion of the income flowing through from these pass-through entities may be subject to the 25% rate, and the remainder is subject to an individual tax rate, or what we would call an ordinary tax rate, which currently is sitting as high as 40%. So we will be watching this closely, and it's something that companies should be paying attention to as well, because depending on the bills that make it through Congress, there may be a really significant rate differential on the tax that would be paid on business income, depending on if you're a C corporation or an S corporation. The bill is expected to be presented to the President by Christmas, and the implementation dates are, the House version is proposing all of these changes be effective in 2018, which is just a couple of weeks away. The Senate version doesn't take effect until 2019, so a little bit more time to do planning and analysis. So it's an area to continue to watch and wait and see. But we are recommending that companies, once we have final versions of the bill, are running calculations to determine, the best structure prospectively. The next area that we want to talk about are accounting methods and credits. We're going to touch on depreciation methods. We'll talk about fiber leases and some tax credits for you to be paying attention to before reform occurs. And again, as I mentioned, because we have the potential rate reduction, especially for C corporations, we're focused on accelerating deductions into 2017 and deferring paying tax until later years. The idea there being if we can reduce the tax that we're paying at 34% on that income and pay it at a future point at 20%, that can give us a immediate permanent tax savings. So we're really focused on, are there ways to pull deductions into 2017? Are there ways to defer revenue to 2018 and later years? And these are some of the areas that we'd have you think about as you're doing your planning. So the first area is depreciable assets. So as you near year end, we're asking companies to really pay close attention to the opportunities to close work orders. So if you have plant that you've been working on throughout the year, looking at opportunities to make sure those are closed and put into service. And to the extent that you can do that prior to December 31st, 2017, then it's eligible for depreciation in 2017. So two of the areas that we think about related to depreciation, the first is Section 179. And Section 179 is a provision that allows businesses, if you're considered a small business, and that's defined as adding less than $2,030,000 in fixed asset additions during the year. If you're a small business, you're allowed to immediately deduct the cost of up to $510,000 of your fixed asset additions immediately. Okay? To the extent that your fixed assets exceed the $510,000, you also then have the opportunity to consider bonus depreciation. So bonus depreciation allows companies to immediately deduct 50% of the cost of fixed assets that you place into service during 2017. So you immediately are able to write off 50%. The remaining 50% is depreciated over the normal tax lives of those assets. So there's a real opportunity to get some significant deductions for your capital assets, your long-lived assets that you're putting into service in 2017. The next area that we want to at least be thinking about and touching on are fiber leases. And a lot of competitive companies have significant arrangements with third parties where they may be purchasing the use of fiber or selling the rights to use fiber. Oftentimes these arrangements are structured as indefeasible rights of use. You may have heard the term IRU. And generally that relates to contracts that will provide for long-term use, usually of a fiber asset, over a period of maybe 20, 25 years. Because these are long-term, and oftentimes the cash associated with that is significant, they can really have an impact from a tax perspective. And the tax reporting for sales of fiber IRUs generally follow the cash. And what that means is that when companies receive upfront payments for these long-term agreements, oftentimes the general rule is that the tax reporting follows the timing of when you get the cash. And that can be a real challenge for companies if you're receiving upfront cash in order to build out fiber, which is you need that cash to put into a capital project. Having to pay tax on that when you receive the cash can be a real burden. So there are some specific strategies that are available for companies around recognizing these IRU agreements. And so to the extent that you have IRUs and are receiving significant cash, there are some revenue procedures and strategies that you can consider employing to defer that recognition, at least over a short-term period of time. Additionally, what we want to be thinking about is, to the extent that you're getting cash receipts, if you are building that fiber and if there's any way to align that plant addition in the same year so you at least get the depreciation that we were just previously talking about in the year that you get the cash, to try to mitigate the recognition. Additionally, when you're purchasing the rights to IRU assets, the tax approach is important, making sure that you're capturing bonus depreciation and the deductions that you're entitled to when you are acquiring these long-term rights of use. And a lot of times the tax methods may be very different from the GAAP accounting for these transactions on your balance sheet. So another area that can have significant impact for you. Okay, the third thing that we'd have you think about are tax credits, especially for 2017. The research and development credit is still available for companies. And the research and development credit has really, the use of this has really been expanded due to some rulings that have come out in the past couple of years. It's much more, the credit is much more available to communications companies than it has been in the past. And so the way that the research and development credit works is it's generally a percentage of your qualified research and development expenses. And normally you wouldn't think of communication services as being heavily research and development focused. However, if you're designing fiber routes, if you are serving customers with new technology or designing your systems to improve the communication services that you're providing, a number of those types of activities can be deemed to be research and development. So we don't know what tax reform is going to do with the research and development credit, if it'll be extended. But if you do have significant dollars that you're spending in this area, it's certainly something that we'd have you review to determine if there are opportunities. So in general, the tax area, as I mentioned, has been changing rapidly. We expect that we will have a very different tax structure in 2018 or potentially 2019. And so now is the time to really review the opportunities. As I mentioned, reduce the amount of tax that we're paying in 2017 and deferring to a future year where we're likely paying much less in tax. Dad, I'm going to turn it over to you.
Okay, sounds great. Cheri, thank you very much. A couple of questions for you here. So first, this one came from the audience, is do most of our clients calculate cooperative member allocations based on books or tax income?
So do most of our cooperatives calculate their patronage allocation? Is that what you asked, Chad?
Yes. Yes.
Okay. I would say that that's pretty split between, we see a lot of companies, I would say most are moving to a tax allocation from a book allocation, but I would say that it's probably still split about equally. Half and half.
Okay, great. Another question that I had for you, Cheri, is I'm just wondering, is there anything that companies should be doing prior to the end of the year to prepare for this potential tax reform, or sounds like it's almost certain tax reform, or can they continue to analyze these opportunities into 2018? So is it time sensitive?
Good question, Chad. So I think that there's lots of opportunity once we have a little bit more clarity on exactly what reform is going to look like. Many of these method changes, the depreciation, the IRU treatment, even the R&D credit, all of those calculations and method changes can be done after year end. I think what the areas to focus on before the end of the year, certainly if there are expenses that you can accrue on your balance sheet, if there are prepaid items that you can, insurance or other things that you can pay in advance, a lot of those types of strategies, kind of one-time opportunities, would be the things to think about before you get to the end of the year. And as I mentioned, you certainly want to be looking at your fixed assets and opportunities to put all of your plant in service that's potentially available to do so. And if there's any fixed asset additions or anything like that that you might be planning to do in January, reviewing the opportunity to accelerate the purchase of those assets and get them into service and get depreciation calculated prior to the end of the year may make some sense.
Great, thanks, Cheri. Very informative. So now I'd like to turn the webcast over to Camille Christansen, who's going to discuss some strategies for structuring leases. So, Camille?
Thanks, Chad, and good morning, everyone. You know, as I thought about what topic I could bring to the group from an accounting perspective, I was surprised really to find myself coming to a change in accounting standards, because generally when we think about accounting standard changes, we think of it as an administrative task or something that just the accountants that we keep in the back room need to think about, but really isn't impactful on how we operate our day-to-day activities. And with a lot of the lease standards that will be effective in the next couple of years, I do think there's opportunity for us to rethink how we view leases and how that ties into the financial goals of the company, along with, you know, maybe ways that we can structure transactions to increase EBITDA and to make that easier with debt covenants, showing the value of our company if we are in a position where others are looking at investing or doing some of those other things. So historically, most of us really tried to avoid capital leases. And the reason we did that is we didn't like the idea of having an asset and a liability, so really kind of grossing up liabilities in our financial statements just for a leasing transaction. And so now that these standards are changing, this gives us an opportunity really to rethink how we view what historically has been a financing lease. And so the couple things that I want you to think about as I talk about the high points of what's changing in the leasing standards is, are we really in a position that a financing lease is the most attractive option for us? And if that's the case, you know, how do we start now in renegotiating those contracts to get that in place? And if you haven't spent a lot of time thinking about the leasing standards, when I use the term financing lease, just think about that in terms of what we previously considered a capital lease. One of the challenges that we do need to think about is, the expense will be accelerated under a financing lease, but as I will show you in a couple of slides, all of the lease expense that we incur under a financing lease will now be an add back to net income to get to that EBITDA calculation. So as we're really managing kind of the financial operations of our company, would we rather have kind of less income in early years to be able to show a more profitable financial position from an EBITDA standpoint? Okay? So as I mentioned, under the new lease standards, regardless of what type of lease we have, we now are going to be recognizing that asset and liability on the financial statements. And so all of those leases that we previously thought about as being operating leases that never showed up as an asset or liability, all of those will now be on our financial statement. And for, I believe, all of you that are on this call, if you have I believe you're all non-public companies, and so if you have a calendar year end, these rules would be effective for you in 2020. If you have a fiscal year end, these rules would apply to you beginning in the year 2021, and you do have the option to early adopt. So what this slide is showing you is really the impact on the income statement of how we classify a lease. So you'll see on the balance sheet, whether we have a financing lease or an operating lease, we are going to have that asset and liability. But we look at the income statement, and anything that we have classified as a financing lease, we are going to record that expense as amortization and interest expense. So that's where we get that add back to get higher EBITDA if we have leases that we now can classify as a financing lease. And then anything that we identify as an operating lease, that lease expense continues to be recorded as lease expense, or for those of you that choose to follow Part 32, would likely be in a plant-specific expense account. And so when we look at that EBITDA calculation, because that is considered a general operating expense and not amortization and interest, EBITDA is lower when we have an operating lease. And then from a cash flow statement perspective, the operating lease will, the entire payment will show up as a cash outflow or reduction of cash from operations, while under a financing lease, the majority of that cash flow will be shown as a cash outflow from financing activity. So if we classify a lease as a financing activity, we also will see an increase in cash from operations on a financing lease. So the important question then to ask ourselves is, first of all, what meets the definition of a lease? And as I've been working with my clients over the last couple of years, really to understand what these changes mean, this really has been one area that has caused a lot of confusion. And the rule changes are very specific about what meets the definition of a lease. So there could be instances where we have contracts with others that we believe are lease agreements, but would not meet that criteria under the new lease standards. And so the first criteria that is kind of the first hurdle to get over to call something a lease is that you have to have a specific asset identified in a lease. So if we have things like we just are buying a general service or we just are buying capacity, and we don't specifically say, I'm leasing the Ford Focus from Telco B, then we don't have the definition of a lease. If our agreement is just, you're going to provide me access for the next 12 months to a vehicle, because we no longer have that specific asset identified, this automatically is not a lease. The second thing that we have to consider is if we have the right to control the asset. So even if we have a specific lease identified, but the lessor really can dictate how the asset is used or can easily substitute the asset at their discretion, not our discretion, then we, again, do not have a lease that meets these standards. And so for most of my clients, as they have applied these two criteria, the contracts that initially they thought they were going to have to spend a lot of time analyzing and capitalizing has decreased pretty substantially. So keep that in mind as you think about your individual agreements is, do we actually have a lease in place, or are we really utilizing a service from what we'll call the lessor? Even though the agreement may say a lease, it may not meet the definition. So the next big piece for you to think about is if I decide that I like the idea of having a finance lease, I like the idea of having higher EBITDA, what do I need to do to ensure that I can classify this lease as a financing lease? So for those of you that have ever analyzed leases in the past and looking at the capital lease treatment, this should look very familiar to you. The concepts are exactly the same. The only difference is the FASB really took away really the rule-based approach and tried to make it more principle-based. So if ownership is transferring at the end of the lease term, we can call it a financing lease. If we have a purchase option that is reasonably certain to be exercised, so in most of those cases it probably is if we have that bargain purchase option, if there's a great deal to us at the end. So that's one slight nuance change from the capital lease definition. The lease term is for a major part of the remaining economic life. So that used to be the 75% threshold. You're probably still going to use that as a guidance, but it is not tied specifically to the 75%. And the other thing that you will think about on this, which may help you meet the finance lease criteria, is the lease term is not just for the stated lease period. It also includes all the periods that have a high or reasonable possibility of renewal. So if you have a 10-year lease agreement with the option to renew annually after that, and you expect that you would renew that lease for 5 more years, now you really have a 15-year lease term rather than a 10-year lease term. Where in the past it was very tied to what was just stated in the contract. Okay. Then we also have what is the present value of our lease payments compared to the fair value of the asset. And if the present value is substantially all of the fair value of the asset, then that would also mean a financing lease. That will be around the 90% criteria that was in the previous leasing standard. And then our final, which I don't think that we'll see this much, but certainly could come into play, is if you have an asset that's so specialized that you make a lot of modifications or couldn't easily be used by someone else, then you would have a financing lease. So as you think about your lease agreements, those are the criteria that you need to think through. Is there a way that I structure the leases to meet one of those? And I think for a lot of us, the lease term may be the easy hurdle to get past, especially for those that we know are reasonably certain that are going to be renewed. And so the thing that you will think about when assessing that probability really are a couple criteria, and that is how significant is it to your operations, and what would the cost to you be to terminate your lease. So one of the examples I like to use here is I have a client that they lease the building that their switch is in. But the lease term is very short with options to renew regularly. As all of you know, it would be very disruptive to just on a whim decide I'm not going to renew this lease and move my switch. and the cost of removing that switch would be very expensive. And so you would assume that you're going to continue to renew that lease for as long as you possibly can. So that's a high-level overview of leases. So the other couple things just to think about, a lot of us have debt. We have debt covenants, whether with the lending institutions. Sometimes we have investors that are expecting to get a certain return. And so think about if I had an opportunity to change something that maybe is an operating lease today and have that qualify as a financing lease, what does that do to my metrics? Does it make it favorable? Will those third parties look upon the operations of our company more favorably? And the benefit to you, if you can make that happen, the cash outflow of your company isn't changing. So whether you have a financing lease or an operating lease, your cash obligations are the same. And I know that, it's really frustrating sometimes, you're managing a company that sometimes just because of the accounting, it maybe makes the financial position of the company look worse than it is. The other thing that we, are watching is, will banks change covenants as a result of these changing in leases? To date, we have not seen anything, but this may also give you opportunity to renegotiate some of those debt covenants that you do have in place, knowing that there are these significant changes in place. Particularly on the balance sheet side, and as we look at leverage ratios, adding significant lease liabilities on your books could cause unintended consequences on those balance sheet ratios that, this is a good opportunity for you to look at and renegotiate with the bank. And with that, I'm going to turn it back over to Chad.
Great, thanks, Camille. Very enlightening. I had a quick question that I wanted to ask you. So I'll just go ahead and throw this out there. What types of agreements are we seeing companies renegotiating to take advantage of these rule changes?
Sure. Yeah. So the two things that I have seen companies really kind of hone in on are, I would say, vehicle leases and anything associated with what I'll just use the generic term, a fiber lease. And especially with a financing, I just go back, with vehicles, companies would work so hard to try to structure agreements just to meet the classification of an operating lease because they didn't want it on the balance sheet. Well, now that both are going to be on the balance sheet, companies are saying, I don't care as much about going through the exercise of making these very restrictive lease agreements on vehicles for a cash outflow that I don't care if I have it for 3 years or 5 years, and I probably would actually prefer to have it for a longer period of time because I can, defer some of those costs. And then on the fiber side, I do think there are a lot of companies that currently are saying, what do I want the answer to be? Am I in a position that I would rather have these classified as an operating lease, or would I rather have them classified as a financing lease? And if my answer is I want these to be a financing lease, what can I do and what can I negotiate with the lessor to make sure that I really do have control of the asset? Can I dictate how traffic is being transported? Can I add my own electronics to pieces of the fiber to make sure that I have that control? On the flip side, there are companies saying, I still actually kind of like the idea of an operating lease, and so I want to make sure that when I think about fiber, that I'm really buying a service or a capacity equivalent rather than specifically identifying maybe what strands of fiber I want my my traffic transported on. And so for most, the analysis really comes down to how do I want my expense to be recognized? The liability is the same regardless of if it's an operating or financing lease. So what do I want my income statement to look like every year as a result of these transactions?
Okay, great. Thanks, Camille. So last but not least, I'd like to turn the webcast over to Tim Rutkowski to discuss some regulatory compliance issues. Tim?
Thanks, Chad. Good morning, everyone, or afternoon, depending on where you're located. I wanted to take a chance to talk to everyone regarding regulatory compliance in the telecommunications industry. Hopefully, as many of you know or have realized, the telecommunications industry is a heavily regulated industry. There are lots of rules that are always changing, coming up with new rules, strings attached to services that are being provided, and a lot of uncertainty about what am I really providing to customers when it gets down to talking about things such as reporting, fees, and surcharges. And so that's where it really helps to make sure you have a good grasp on these compliance issues. And one of the main challenges with that is that the rules and regulations concerning telecommunications is always lagging behind the technology and the advancements we make in our industry. A great example would be VoIP services. The rules that have governed VoIP, they've been trying to pigeonhole them into what was traditionally your public switch telephone network and local service offerings, when there wasn't an internet or where you didn't touch the network of your local telephone company and it just rides over the cloud. So with these changes in technology, the rules generally align, and so that's where there can be a lot of confusion regarding how do I appropriately report and comply with the taxes and fees and surcharges regarding them. And then with the vast amount of service providers, there too are a lot of different reporting requirements and application in terms of governance over those entities, whether it's the types of services being provided, whether it's VoIP, broadband, wireless, just reselling of transmission services. Where those services are provided also dictate quite significantly into the application of fees and surcharges, such as states, whether or not they govern and have regulations, exerted regulations over VoIP services or broadband transmission services. And then lastly, whether or not you're receiving federal universal service support or state universal service support. Those subsidies that are given to you generally come with strings in the form of compliance reporting to make sure you're using these funds for their intended purposes and aren't just putting them into your back pocket. So the point being here, really, even when you're offering what you might consider to be a non-regulated service, there will be some fashion of regulatory compliance reporting, whether that's to a state PUC or a public service commission or to the federal government in the FCC or USAC. So why does this matter? These can, especially fees and surcharges, can affect your bottom line, whether it's fee assessment or the cost recovery. The biggest one being the federal universal service charge, currently 18.8%, which is a very large number and just expected, which I'll get into in a minute, to expect it to grow. So depending on how you classify your revenues, there are some strategic opportunities that we can minimize that fee assessment and in turn mitigate some of that cost recovery you need to get from your customers. That then leads to the attractiveness and competitiveness. If you're able to lower those additional fees and surcharges that you have to charge to your customers, does that give you an edge when you are competing with other carriers who in turn are also charging these? So there is some opportunities there. Obviously, non-compliance penalties and fees. If you choose to ignore or forget to file certain filings, there can be some significant monetary penalties in terms of repayment to the Universal Service Fund, late filing fees to the state public utilities commissions that can be substantial depending on whichever report we're talking about. And then also preparedness. I mean, as technology is always changing, rules and regulations are following suit. So there's always one thing that's constant in the telecom industry is change. So staying on top of those changes in terms of compliance is very important. So I'd like to talk about a few of the compliance forms, probably to me the most important one, or one of the most important ones being the FCC Form 499. Hopefully some of you are familiar with it or have at least heard of it in some fashion. This is the form reported to USAC in terms of your gross operating revenues, including your non-telecom revenues, and it's done on a quarterly and annual basis. This is required of all telecommunications providers, whether you provide VoIP, you provide broadband, wireless, or just wholesale transmission where you don't actually have any end-user customers. You are still required to file an FCC Form 499. This is the basis for your contributions into the Universal Service Fund. And as I said, the current factor is 18.8%. The estimated first quarter factor for next year is expected to be 19.3%. So that obviously on top of a $1,000 bill adds up to be quite a significant portion as an add-on that a customer may not be aware that is going to be added on to their service when they signed up. So in line with that, there are strategic options to minimize that. For instance, if you're a VoIP provider, how you're pricing that and selling it to your customers can impact, which I'll get into more detail on the next slide, whether you utilize the FCC Safe Harbor percentage or utilize a price list for determining your local and toll revenue charges. Also, if you're providing broadband, are you self-provisioning the transmission component? And when I say transmission, I always envision a garden hose. The garden hose itself is the transmission. It's the pipe over which the water or the internet access flows. So depending on how you tariff or price those as a bundle separate can impact how, in terms of reporting and therein an assessment to the Universal Service Fund, reducing that amount, there can be some opportunities there. So I said here is an example of a VoIP pricing strategy. I use a very simplified VoIP service that is all-encompassing of local, toll, long distance. So really for $39 a month, I can call anywhere I want. Option 1 utilizes the FCC Safe Harbor. This is where the toll and the long distance are bundled together as one distinct amount of $39.99. Using that 64.9% Safe Harbor percentage, which is just prescribed by the FCC. There is no need for backup or support if you utilize this option, which is why some companies choose to do it. You apply that percentage that develops your interstate revenue piece, which is $25.95, and then multiplied by 18.8% comes up with a $4.88 of USF contributions that you need to pay into the fund. Option 2 is using a price list method. So determining that I'm going to establish that $19.99 is my local calling piece, the remaining $20 being my long distance or toll piece, then using those same applications and jurisdictionalization of 0% to the local and 100% interstate to the long distance, you can see that you come up with a much lower USF obligations. Now in this obvious one customer scenario, it amounts to only $1.12, but as you scale that, have thousands and thousands of customers, that can add up to be quite a change, especially if you do not choose to pass on this USF fee to your customers and you just eat that as part of your cost of doing business. Following along on the subject of telecommunications taxes, fees, and surcharges, there are a vast number of fees and surcharges that can be applicable to telecommunication services. These can vary by state authority, depending on whether or not the state has exerted authority over VoIP services. VoIP being getting the digital transmission of voice communications, whether this touches the PSTN, the public switch telephone network, or not, whether it's non-interconnected VoIP. These all play into what the assessment and applicability are. 911 charges, which are the fees that state or local municipalities collect to run the 911 network. These are generally always present on a VoIP service. These are applied on usually a per line, whether it's 75 cents or $1, or on total gross revenues as a percentage, and remitted to that state or municipality. If it's on a per line basis, so if you offer a SIP trunking solution where you have so many concurrent calling sessions but seats or phone numbers behind it, you would apply this based on the number of concurrent calling sessions. So if everyone picked up their phone at once, how many calls could get out? And I just provide a couple of the different fees and surcharges that can be applicable to VoIP, whether it's the FUSF, state USF if there is one, E911, telecommunications relay services, state and local tax, and there can be a multitude of other state and fees. So as you're expanding, providing services to new locations and new businesses across the country, I would strongly recommend looking at whether or not VoIP, if you're a VoIP provider, how these fees and surcharges, if there are any, are applied to your VoIP services. I also want to bring up special access jurisdictionalization. When you are selling a special access circuit or private line, USAC adheres to the 10% rule. And that is that if 10% or more of your circuit, the traffic riding over that circuit would be considered interstate, the entire circuit and revenue is considered to be interstate. Internet itself is an interstate service. It would be hard to argue that internet would be confined to purely an intrastate source. So very important that when you're selling special access circuits to your customers, make sure to get the customer to declare that, whether it's at the time of their order, telling you that, hey, in accordance with the 10% rule, this is an intrastate service, this is an interstate service. USAC will not question if you get that jurisdictionalization. And as a caution, a PIU on an access service record is not necessarily 100% sufficient to cover you. Another form required of most all providers, whether it's broadband, VoIP, or service, is the 477. It's a semi-annual reporting of subscription and deployment for voice and broadband services, whether it's at the census tract level or census block level of detail. And it's required of all providers of broadband, local exchange telephone, mobile wireless broadband, facilities-based mobile voice, as well as interconnected VoIP. So if you're providing any of these services, you should also be filing a semi-annual FCC Form 477. And this is used by the FCC in their policy development and regulatory reform. They look at where are services being deployed, so they can target what do we need to do to get them to areas where service is lacking, and has been incorporated into a lot of the decision making that they've used for changes to the Federal Universal Service Fund and targeted support mechanisms. And lastly, just want to provide an opportunity here of Lifeline services and reporting. If you are providing voice or broadband, offering Lifeline services could be an opportunity for you to get more customers in getting a subsidy for them through the Federal Universal Service Fund. It does require being an ETC, an eligible telecommunications carrier, and this is a status granted from your particular state commission. Currently, the credit offered to a Lifeline customer is $9.25 for either voice or broadband. You cannot get one for both. There are minimum service requirements, whether it's the speed of the broadband, the minimum usage allowance, whether it's 750 minutes for mobile or 3G for mobile broadband. If you provide those services and currently you are not offering Lifeline, it could be an opportunity to look at that. Could I get more customers into my business from a competitor, while at the same time getting additional recurring revenue in excess of that? The focus and support of this 925 is moving from voice towards broadband. It's becoming the new universal service that everyone should, that the FCC considers to be, and everyone is entitled to get fast, reliable broadband. The thing to caution or note with that is that becoming an ETC, receiving federal universal service funds, there are strings attached with that in the form of additional reporting requirements. That would be either monthly submissions to get the receipts of 497 or annual reporting of the FCC Form 555, which are just Lifeline subscriber counts. There is also the process of the annual reports to the FCC as well as the state commissions to maintain your ETC status. And you do need to advertise, as you probably would in any case, that you are offering Lifeline services. So basically, in essence, if you're not offering Lifeline, this could be a new opportunity for you to get more subscribers onto your network. And with that, I will turn this back over to Chad.
Great, thanks, Tim. I know that you probably touched on this, or I think you did touch on it early in your presentation, but I wanted to just reiterate or re-ask the question that, that I know that regulatory agencies don't really provide a pass on any of these filings, and they vary from one company to the next. But which of these regulatory filings that you talked about, or maybe there's another one that you would say is the most vital to a company's operations?
Well, I would say that the FCC Form 499, the revenue reporting, is certainly one of the most important ones that you, as a telecommunications carrier, would need to file. It also is the one that has what I would say the greatest opportunity for helping your either margins or bottom line in terms of how your revenues are developed. Some of this, there are hard-cut rules, but there are some, I would say, gray areas where there is opportunity and a little more art than science in terms of getting you to a more desirable outcome. It's also the form that really says, hey, I am a telecommunications provider when you're registering with the FCC and getting the various identification numbers that you need to get to provide telecom services. That kind of says, hey, I am doing business here from henceforth.
Okay, great. Well, thank you very much, Tim. Really appreciate it. It's hard to believe all these regulatory reporting requirements that are out there, and I know that sometimes it can be confusing as to what applies to which type of carriers. So I appreciate your insight. So I wanted to close by thanking you all for your participation on today's webcast. We really hope that you found it to be beneficial. If you do have any additional questions or require assistance with anything we've discussed today or any of the services that I outlined early in the webcast, please feel free to contact any one of us. Names and contact information and nice pictures are provided here, and we'll put you in contact with the right Moss Adams expert to meet your needs. Please do remember to keep your eye out for future Moss Adams webcasts on issues relating to competitive telecommunications providers. Our hope is, if there's significant interest, that we'll continue doing these hopefully on a quarterly basis. I do want to ask that you please take a moment to complete our post-webcast survey. I've included the URL here. I know it's fairly small and fairly lengthy, so hopefully can give you a second to go ahead and get that down and make sure that you do provide some feedback there as to what topics you might like us to cover on future webcasts, maybe others that we should be inviting to these webcasts to make sure that we're touching base with the right folks in the industry. And so on that note, I would like to thank everyone again, and please do have a great week. Take care.